You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, Market Moose, this is Mike from The Moose on the Loose. I hope you're doing well today. Today, I want to do a quick review of a 8-step buying process. So the key here is to make it easy, make it simple. And of course, in 10 minutes, that's not enough to cover everything. But I just wanted to give you a quick overview on how I select the companies that I look at when I'm about to add one stock in my portfolio. And as everything else, I like to keep things clear. I have to keep things simple. And this is why I only have like 8 steps to search for a new stock. So step number 1, I use a stock screener based on the dividend triangle. And you probably guessed it, it is definitely the Rockstar list. So what I do is I go on Dividend Stocks Rock and I pull out a list of all stocks. At this time, I'm not looking for like a narrow search. I'm looking for a wide search that will give me all companies that have been thriving over the past 5 years. So 5-year revenue growth positive, earnings per share growth positive for the past 5 years as well, and same thing for the dividend. So those are like the 3 metrics of the dividend triangle. So no payout ratio, no PE ratio, no cash flow metrics, just I want a company that grows their sales, that grows their profit, and share the wealth with the shareholders. That's how I'm looking at this point. So that's step number 1. Step number 2, of course, by pulling out this kind of filter, you're going to have like more than 100 stocks, and you're not going to review 100 stocks. That doesn't make any sense. So I'm going to go for the stronger dividend growers. So I will highlight all companies with a very generous dividend growth over the past 5 years. So I already have those 5 metrics. Now I sort them by the strongest dividend growers. Now, when you do that, what will happen in many cases is, depending on the time and depending on the economy, you will have 1 or 2 sectors that will show many companies with strong metrics. And at the same time, on the opposite, you will see many companies that are having a hard time. So depending on what's going on. So step 1, you pull out your stock screener with the dividend triangle. Step 2, you highlight stocks with high dividend growth. And then step 3, you do not select all the stocks from the same sector. So only select sectors that you are interested in and that you understand. If you don't understand a sector, or that you're already full of it, so right now, if I pull out the screener like this, I will see many technology stocks, for example, that are thriving because there's a lot of good positive stuff that's happening in the technology these days. But I'm already overweight in technology, so I'm going to narrow down to the sectors I need in my portfolio. So the one that I understand, that I'm comfortable with, and that I can explain to a 12-year-old. Because if there's a sector that you're not comfortable with, it's not worth it to invest. You're going to miss stuff, and this is not what you want. You want to be in full control. So stock screener, highlight the dividend growth, select only good sectors for you at this time, depending on your goals, because there are great companies in all sectors. You just want to have sectors you understand and that you're not overweight. Then take a look at the dividend safety. So it's one thing to have a strong dividend grower, but at this time, you want to look at the trend. Is the dividend keeps on increasing at a steady pace? Is the earnings is following? So the payout ratio is in line. How's the cash flow metric? So now it's all about selecting companies that, yes, has a strong dividend triangle, strong dividend grower in the sector you like, but also have a solid dividend safety. So plenty of room to keep on increasing that dividend going forward. Because keep in mind, what happened in the past doesn't necessarily mean that it's going to happen in the future. So once you have selected those companies with a strong dividend safety, now it's time to, you have narrowed down your list, and it's time to look at the company's business model. So then you do a little bit more research. If you're a DSR member, it's super easy because we have stock cards explaining you the business model. So the key here at this point is to be familiar enough with the business model that you can explain it to a 12-year-old. So make it super simple. And if you're able to do that, this means you understand how this company is going to make money in the future. And you're also be aware of its risks and challenges at the same time. So understanding the business model is super important. And then you can reflect on the fact, well, do I think that there's a future for this type of business in the next 5-10 years? So you already narrowed down with financial metrics. Now you're going a little bit more on the qualitative side, thinking about the business model. To help you do that, we reach step number 6. So identify potential downsides and potential upsides. So you can do kind of like a SWOT analysis. So the strengths and the weaknesses, the opportunities and the challenges, the threat. So you want to know what could go wrong and what could go right. Why you want to do that? Well, of course, if you're just looking at companies with strong metrics, strong dividend safety, high dividend growth, a great business model, and you just look at the upside potentials, you're going to get hyped on it and you're going to forget about knowing that any business, every single business have their challenges and their downsides as well. Things could go wrong even for the perfect business. So you need to highlight that to make sure that you are willing to live with those kind of risks. That is the most important part, is to know, do I want to live with that kind of risk or not? Now we're at number 7. So number 1 was using the stock screener. Number 2, highlighting dividend growers. Number 3, selecting sectors. Number 4, dividend safety. Number 5, explaining the business model. Number 6, identifying potential downside and upside, so risk and growth potential. Now, number 7, now it's time to look at valuation. And I'm not a super fan of valuation, but I kind of like to look at a stock valuation by looking at the average past 5 year for the yield, So dividend yield over the past 5 years was the average, and the PE ratio. Why? Because on average, a stock will trade about the same yield and will trade around about the same PE ratio. So the market in general will be willing to pay about the same multiple of the earnings over time, unless there are a major change in the environment or in the business model. So when there's a big discrepancy between the average of the past 5 years and the current PE or the yield, then ask yourself what's going on. So put those numbers into a context before pulling the trigger. That is super important. So if the valuation makes sense, I'm not looking for a deal here. I'm just looking to not pay something like 5 times I should be paying. And if it happens, well, then I'm going to try to put some context and understand why the market is willing to pay a lot more today than it was 2-3 years ago. But in general, this is just like a safety check to make sure that I'm not going crazy about a stock. So once the valuation is done, number 8, the most important step before you click on that buy button is write down your investment thesis. So write down all the reasons why you want to buy this stock and add it to your portfolio. Why it's so important? Because in the future, this will become your reason to sell as well. So the investment thesis is it's a combination of the qualitative and the quantitative. So the entire buying process I've discussed today was all about quantitative analysis, so looking at numbers, ratios, financial metrics, and trends, and then qualitative, understanding the business model, identifying potential downsides and upsides, having like building a narrative. And once you have that investment thesis, you will be able to go back in time and review your thesis versus the numbers and make sure that it's still making sense 2 years, 3 years, 10 years down the line. And as long as your company, the company that you bought, matches your investment thesis and show numbers, well, then you're good to go. You can hold it forever. I mean, of course, it's not going to happen. We all wish we hold stocks forever, but it's very difficult. So quick summary moves before you go. Step 1, use a stock screener. Use the dividend triangle, or download the Rockstar list at moosemarkets.com/rockstar. It's going to be a lot easier. Step 2, select strong dividend grower. So sort by dividend growth over the past 5 years. 3, select the sectors you understand and you need in your portfolio. 4, focus on dividend safety, making sure there's more room for dividend growth in the future. 5, dig inside each company, understand the business model, repeat it to a 12-year-old to make sense. Number 6, identify potential downsides and upsides so you know what you're investing in. Number 7, look at valuation, average past 5 years for the yield and the P/E ratio. That should help you make sense of the price you're paying today. And number 8, write down your investment thesis before you click on the buy button. So there you go. That's my buying process in 10 minutes. Pretty cool, right? All right. So if you want to have some tools to help you out with this, well, you can go on moosemarkets.com/workbook or moosemarkets.com/rockstar, and you will be rockstars, sorry, with an S. You will be able to download a bunch of resources as soon as you subscribe to my free newsletter. Because my goal is, again, help you invest with more conviction so you can enjoy your retirement. All right, Moose, that's enough for today. I hope that you will have a marvelous day, and we're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.